start of 2 years, we have been educating our shareholder base, continually messaging quarter after quarter exactly where this business was going. We told anybody that would listen, we were building an infrastructure that would scale, that once the platform was live, revenue would flow, and that profitability would follow soon thereafter. This quarter is that thesis playing out on the page in the numbers. This is precisely what we built the company to do, and we are energized that the results that we're showing in reality. Let me start with some questions I expect are on many people's minds. What were the one or two things that drove a record quarter like this? Was it a single large client or a particular pharmacy line, perhaps? To be honest, the answer is quite boring, more boring than I think most people would like, and that is exactly why I find it so encouraging, actually. There was no single driver, no single customer, no single product. Rather, it was everything working together at the same time, the way it was designed to. Existing partners continuing to ramp, new partners continuing to be onboarded, and our pharmacy network and product catalog deepening underneath all of it. When a quarter like this depends on an individual client or a product, it's very difficult to be sustainable long term. However, when a record quarter comes from every part of the engine turning at once, it's far more durable, far more repeatable. I think that more than any single number is what has driven these results and gives us confidence in what lies ahead. Next, I want to address regulation directly, because it is probably the single most question we get from the investor base, and candidly, that's totally understandable. The legislation and regulatory environment around digital health, telemedicine, and compounded medications continues to evolve, and yes, in many respects, it continues to tighten. Here is what every person on this call I'd like to, here's what I really would like to clearly get across. That tightening is not a threat to Hydrate, it's a tailwind. And I cannot say this strongly enough, and we've spoken about this multiple times on multiple webinars. As the rules grow more complex, as regulation increases, enforcement grows, the bar to operate in this space compliantly only continues to rise. Operators who are not compliant or who try to cut corners will get removed or squeezed out. And the businesses that want to participate in this market long term legitimately scale across multiple states, 50 states in most cases. Increasingly, they cannot do that alone. They need precisely what we have spent years building, which is an ecosystem for the digital health space in the United States. It's really about the division of labor. Our customers are the front end of the telehealth funnel. Their focus is on customer acquisition, building a brand, and bringing patients in the door. And that is where their energy and their dollars are best spent and should be spent. Hydrate lets them focus on exactly that. We take care of everything behind it, the compliance and regulatory requirements, the administration, the prescriptions, and the operational fulfillment. Basically, the operations of medical care. That separation is our value proposition. And as the back end gets harder and more expensive to manage, more legislatively curtailed, the more essential we become to the front end. So the regulatory screw continues to tighten. It only funnels more of these operators onto our platform, not away from it. We are seeing this in real time across the platform as new operators seek us out to solve their regulatory problems. And we're seeing it not only in real time, we're seeing it in results, as everyone can see here from Q1. The next area I want to spend a moment on is the consumer demand side, and what we are seeing in the market. As most people on this call know, the market for health and performance products has been growing rapidly as more and more consumers focus on fitness, recovery, longevity, weight management, and overall wellness, preventative healthcare as opposed to sick care. Peptides, of course, are the belle of the ball, are the most well-known example of this, but it's much larger than that. And we don't have to project this trend or take it on faith. We see it in the order flow moving across our platform, and we see it accelerating. To add a little bit more color to that, and just to kind of just to kind of showcase that where this industry is going, the FDA are holding a public hearing on July 23rd. It is the Pharmacy Compounding Advisory Committee board of the FDA. Public 2-day hearing in July 23rd, inviting pharmacies, companies, physicians to have an open review process around 7 peptides and the release of those. This is on the back, of course, of 14 that were released already in February, and this is the movement. Some of the peptides on there, people would know BPC 157, TB 500. Some of these things that are in the public space right now, and done kind of uncompliantly, but this is where absolutely the industry is going. There's a second meeting already penciled in for February in 2027, and this showcases the movement towards preventative healthcare, the movement towards these additional products being accessible in a compliant fashion. Obviously, Hydrate spends a tremendous amount of money on compliance. We've been doing this for 8 years, while the market has come towards us in many cases with these patient-specific self-administered products being released over the last 2 years, and an ecosystem needed to support those. This isn't new to us. So we've been structuring the company accordingly for quite a while now, and we're uniquely positioned to support the businesses as these products release and as this movement continues and as regulation tightens. That's part of what makes this so powerful for Hydrate. The leverage our platform brings, which is something we have talked about before, but it warrants repeating. As new product and drug categories are released, we don't need to onboard them on a partner-by-partner basis. Rather, we onboard them once to our platform, and then we can make them available to our entire customer base. So one new category becomes thousands of new revenue opportunities for both our partners and for us in a single motion. When you layer that leverage on top of what we believe is still the early innings of a structural shift towards patient-led healthcare, you can see why we remain so excited about the road ahead. Next, I want to talk about our platform itself, and how this quarter presents the clearest signal yet that it's performing as intended, as the results show top-line growth paired with rising profitability and operating leverage. To put some numbers to that, in Q1, we were able to grow our revenue 67% over the prior quarter with no increase in operating expenses. That gap is the platform doing its job. Our cost base, the compliance framework, the provider network, the technology is largely fixed. So as more volume flows across the platform, very little incremental cost follows it. Looking at it another way, operating expenses fell to roughly 9% of revenue this quarter. That's down from 15% just last quarter, representing a 41% overall decrease. And while we acknowledge these are already strong growth and profitability numbers, we'd ask you to keep in mind that we remain in the very early stages of scaling, having launched the VSDHOne platform from a revenue-generating perspective only 3 quarters ago. We believe these are early indications of what the platform will ultimately do once it hits its stride. As we turn to our balance sheet, we're happy to report we have only enhanced our financial position since the end of 2025. We closed the quarter with 24.2 million in cash and roughly 32 million in working capital, having completed an oversubscribed 15 million financing in January. With that backdrop, let me turn to the financial results a little bit more detail. Revenue for the first quarter was 24.9 million, compared with 4.5 million in the first quarter of 2025. I'll pause there and let that one sink in for a minute. Growth of approximately 450% year over year. Sequentially, revenue grew 67% over the 14.9 million we reported in the fourth quarter of 2025. On an adjusted revenue basis, which reflects gross cash receipts before the deferral of certain business partner contract revenue, we generated 27.6 million versus 6.5 million a year ago. So again, validation of our moat in real results as opposed to structure. Sticking with our top line growth a moment longer, I want to show this next chart, which shows our revenue on a trailing 12-month basis. We think this does a good job of really showing the step change in growth we're seeing in the business right now. Our trailing 12-month revenue is currently 55.8 million, up from 18.5 million just 3 quarters ago. Right before VSDH1 launched, that's nearly a tripling in 3 quarters. The most recent quarter alone added more than 20 million to our trailing revenue base, taking us from 35.4 million to 55.8 million. That is by a wide margin the largest step change we've seen, and it reflects the order flow building through VSDH1 and inflection we've been working toward. Underneath that inflection, I think the consistency is also worth noting. We're now strung together more than 15 consecutive quarters of growth, an unbroken 4-year climb. Again, continued validation of not only the ecosystem that Hydreight has built, but basically knowledge of where the market is going. Moving below revenue, our gross profit was 5.1 million, a gross margin of approximately 20%, compared with 1.5 million, or roughly 33% a year ago. The decline in gross margin is a function of revenue mix, as pharmacy sales, which carry a lower margin, significantly outpaced the growth of the other revenue streams. Operating expenses for the quarter were 2.2 million, and as you can see by the chart, have been held largely flat over the past 12 months. Over the same period, we've grown revenue significantly, which has driven our OpEx as a percentage of revenue down from 36% to under 9% in the most recent quarter. This operating leverage flows down to our adjusted EBITDA, which was 3.3 million for the quarter, compared with approximately 200,000 a year ago. Our adjusted EBITDA margin reached approximately 13.1%, up from 5.9% in Q3 of 2025 and 10.6% in Q4 of 2025. That represents 3 consecutive quarters of margin expansion. Net income was approximately 2.6 million, compared with essentially break even a year ago. In terms of cash flow, we used 4.9 million to fund operating activities during the quarter. This was driven by an increase in working capital, principally an increase in pharmacy sales receivables that are tied to the launch and securing of the customized compounding product lines, to secure the expansion into these other products. Having closed the quarter with over 24 million in cash and a working capital surplus of over 32 million, our financial position remains stronger than it has ever been. Turning to our outlook, we have guided to 25 million of revenue for the first quarter. We delivered in line with that guidance, reporting 24.9 million in revenue and 27.6 million on an adjusted revenue basis. For the full year, we are reaffirming our guidance, of course, of a minimum of 150 million in revenue. As we previously stated, and as we went over with the release of additional categories of products, with the movement towards the FDA, including pharmacies and organizations and physicians and businesses towards this movement. As these products are released, we see significantly strong opportunity in Q3 and Q4 of this year as well. This baseline is derived solely from existing partner relationships and currently active current programs, observable transaction volumes and contracted demand, and continued utilization of our existing pharmacy and platform infrastructure. So importantly, it does not assume any contribution from potential acquisitions, expansion into new international markets, or additional enterprise partnerships beyond those already in operation today. It is what is already in the ecosystem, and it is more of an executional challenge. Hence our confidence one, and our execution, as you've seen in our Q1 numbers. On that revenue base, we expect to generate an adjusted EBITDA margin of approximately 15 to 17%. The drivers behind this number are visible to us today, and our first quarter results are consistent with the trajectory that underpins the full year outlook. To close, the first quarter delivered record revenue, record profitability, positive net income, and a strong, well-capitalized balance sheet, and it validated the operating model we have spent the past several years building. The regulatory landscape is moving in our favor. Consumer demand for the categories we serve is accelerating, and the majority of the value embedded in our existing partner base is still ahead of us. We look forward to meeting again in a few months to present our Q2 results, which continue to build and extend on the momentum we've presented today. Very, very exciting times for the company, and we appreciate everybody's support. Thank you for your time this morning and continued support of HYDRATE.
Thank you, Shane, for that too. And thank you everyone for joining us this morning. This does conclude today's conference call, and a replay will be available on the company's investor relations website at hydrate.com shortly. We will now just end this webinar here, and we'll also be sharing a recording as well shortly after via email to everyone.
Oh.
Thank you so much, and have a great rest of your day. Bye now.
Well, that's nice they'd be sending I was expecting a question and answer thing, but overall I think I was pretty positive. Sorry for starting that a little bit later. I missed it by about 4 minutes. But yeah, it hasn't started yet, but HYDRATE had a nice little bump yesterday. I was going to make a video yesterday, but I decided to wait till their earnings were out. Let me check and see. I believe, do I have, looking at Hive because they were behind. So I just had Gemini summarize it a little bit from their balance sheet, but overall not a bad quarter. Most of this was like in line or an expectation. 449% year-over-year growth is nice, but we were kind of expecting a pretty big bump already. All the numbers, though, are looking pretty damn good. They're up from the last time I was looking at their numbers. They had about 11,000 licenses that were in production. Now they got about 12,000. They're in every single U.S. state, and they got plenty of cash. I believe that they're, let's just check there. Zeta's down a little bit in pre-market. That's okay. Zeta's doing nicely. So these guys are still at a 182 market cap. Well, still, I mean, like they're up 10%, so that's probably up 18 million in the last day. Revenue is doing nice. Trailing 12-month revenue, like I said, in the video was, well, I forget what they said in the video. That's the first time I saw it, but this is going to start going up and up every quarter because their revenue is going a little bit exponential, which of course won't go for forever. But as far as microcaps go, the fact that they are profitable, growing so fast, they're not losing money, they're gaining cash in their balance sheet. Their business is expanding quite nicely. All of the pistons are firing perfectly. I don't know for sure, obviously, what's going to happen with the price, but we're at least getting back into our previous area of consolidation and resistance between the 280s and the 390s. just the bouncing around right here. We probably got a lot of people that were stuck in it at this point. We started another consolidation round over here. It's been trying to break out for a while, but yeah, we'll see how it goes. There's a lot of other crazy things happening in the market. I sent a message to my brother basically going like, I need more money because there's too many things to buy. I mean, you know, I wanted to buy CoreWeave at some point, but I try to buy in a minimum of 100 share blocks just to hold eventually being able to sell covered calls. You know, I wanted to buy service now, but actually I did for a little bit, but I decided to transition into some smaller companies. And also they were a little overvalued as far as their metric. Like as an example, Micron, despite its meteoric rise, is still technically undervalued as far as its price to earnings and financial metrics. So, yeah, we'll see how the market does today. Don't have to blast through and look at a whole bunch of other stocks as far as what they're doing, but overall things are definitely going up. There's a nice little pop in the market. So I wanted to record that mainly because it was really early in the morning. I didn't think anybody would be able to watch it, but I guess they're going to have a recording at some point, so no need to watch this if you find that on your own. So, oh my God. $82 at the high. BLD is up a bit. Where's the IREN? Somewhat stable. Reddit is another one I really wanted to buy. I actually bought calls right here, made a decent amount of money as it went up, and sold it. I think, yeah, 120 to, I forget where I bought it. It was a while ago, but you know, this is one I would have liked to have owned and bought at the lows because this is where I bought the calls. And I mean, I think it's still undervalued long term, but I just don't have 17 grand sitting around to buy 100 shares, and I don't want to buy, you know, 10 shares of it. The only company I really bought a small number of shares on was Micron, around the 500s, because yeah, I also did not have 50 grand sitting around with which to buy things. And to make extra cash, it's hard to sell covered calls. Because Marvell's one I missed out on. I was actually buying it like in the lows right around here, or right around here. I forget where it was going up and down, but I was just holding on to it for forever while companies like Intel and everything else was going up. So I sold out of these guys, and I'm not a good investor. I'm just kind of an idiot. So no one should really pay attention to what I'm doing. But anywho, yeah. Nebius. The reason I was looking at Nebius is because I keep thinking about when is the right time to sell a covered call on them. Because a 6-month covered call for Nebius at like $300, especially after the price that it's popped up to. Although I guess it's getting back down to its high from the previous day. Selling like a $300 call towards the end of the year, or even a $350 call. You know, that's getting close to $10,000. So as much as I like Nebius to keep going up, part of me wants to just I'd like to try to sell a call on them and then have the stock just tank for a couple months, just not even tank, just consolidate, go down to 250, 240s, low 200s, and let them earn their valuation and grow for a while. But based on the way these guys are growing, I don't know where they're going to go, but I'm scared to sell a covered call. I had a covered call on them, I think back in back in this area. I don't know what time. I think I would have picked the higher time, but um, I forget what it was. Around the low hundreds, I sold a call for 200 for the end of the year. I made like $1,200 on it. I was like, oh, this is nice. I'm sure they're not going to go up to 200 by the end of the year. They've already gone up a bunch. You know, their peak is at 130. And anyway, they went up to like 120. I think when they went up to this point right in here, I bought the call back. I spent like $1,800. I don't know when I did it actually. It could have been here. But long story short, I ended up losing money buying back the call because I didn't want to lose the shares. And I didn't want to roll it on the off chance it skyrocketed. So that same call, had I just ignored it and not rolled it, would be worth like $15,000 right now. And it would be very hard to buy it back. So I don't know if it'd be worth 15. It's worth at least 12 to 13,000. I looked at it yesterday. Because yeah, Nebius is just exploding. But the market open, guys. I guess we'll see how everything does. But I'll end the video. I'll end the stream. I just wanted to cover the HYDTF thing real quick and just check some things out for a while. But we'll talk to you later, guys. Hope you enjoyed the webinar. I think HYDTF is, what are they doing? Oh, all right. So we are having a little breakout today. Look at that volume, 15, 16, 1,800 shares. Nice. It's getting into overbought territory, which is a very good sign. This could be the start of a little breakout. So I don't know if I think as it opened at 390, down to 360. I don't know how many people are going to come in and buy it at this price, but yeah, if we can get the price up to the 4, maybe 5s, that's NASDAQ worthy. As they prove profitability, institutions could start buying it. You know, at these guys' price, it wouldn't be too hard for a big company to just come in and buy them outright, which I don't know if that's feasible or not. But I need to stop watching Marvell. I'm not going to buy it right now. It's overvalued as far as its current metrics. I know they have huge deals, and that's why they're pumping, and they could go up to, I think Jensen said that they could go up to $1 trillion soon. So we're looking at $1,000 company minimum if that happens. So yeah, that's a big. But I just don't have the funds to. I don't have the funds to really get into this right now. I don't have the funds to get into a lot of things. I just can't afford the everything I think I talked about. I bought calls for SMCI down here for a few months out. Got up to here. I think I bought them at 30 down here, and I think I sold them right around this area, just being like, I thought they were gonna chop around here for a bit. I thought there was gonna be a breakout. I should just trusted myself. I mean, but every time I look at my list, I'm filled with regret. Don't get me wrong, I'm in a lot of good things that are doing well. We own Amcor, low price, Wolf, PL, Navitas, Applied Digital, Nebius at a low price. But got out of SMCI, got out of Marvell. Yeah. Yep. So, ooh. You guys doing a little breakout? This is the other company that I was not going all in on. This is my next multi-bagger. Let me just check something real quick. Interesting. So they're breaking above the 150. This is like everyone has their own different opinion on what the best marker is. This is the only one I have on this side that I look at every day. This is a couple other ones. This has the 50, the 10, the 200. And this is kind of showing the general trend of a stock where just don't buy, don't buy, don't buy, don't buy. This would probably been a good place to buy, but I didn't buy it there. I think I bought it literally at the low 60s. But yeah, we're starting to turn around. The choppy trend, we're going up a bit. Short-term trend is rising. Yeah, I think that's interesting. So they opened up high, bumped up a little bit. Well, all right, I could just sit here and blah 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 about a bunch of things that without giving any substance. So I'll just shut up for a while, and I got my own streams to watch. See what's going on in the world. Good luck, guys. Very positive day for Hydrate. So far, not it's like a big sell going on. Not too much, but it's definitely almost got to the fours at the high, and let's see if it turns around today. Don't know if they will, but definitely bullish signs, and they confirmed their projections at least for their revenue, which is very positive. So that might be what's happening. It's a little bit of a sell the news thing. It's not going to tank. I don't think it's ever going to get down to these lows again, personally. I, of course, could be wrong, but very good sign to break out of the 150. Let me just check. Yeah, I don't know what was going on this day right here. That's a weird pump up right there, but it's just been choppy, not going down too much. This was a little bit of a dangerous moment right here, but it closed above the 200, and it just breaks below it and then up recovers, breaks below it. So there's, to me, this is some type of support is building up right here. They don't want to go below the 200. It's breaking out above the 10-day. It's really trying. The 50's coming up, and we could be looking at in a week if the 50 breaks over this and this keeps going up, we could be in a really nice place. It's hard to do TA on penny stocks because they're a little bit more odd and volatile, and there's less institutions, if any institutions, that are working on it. But still slightly trending down. These guys are starting to trend up pretty strongly. If we can kind of keep this momentum going up, we could be looking at a new support level for a while, because I've been really trying to keep it at the 3 mark for a while. Breaks down, goes up, breaks down, goes up, breaks down, goes up. They're trying to keep it up here. So I don't have any price projections, but I am excited. They are getting their cash together. They're still planning to buy back shares, so that's gonna, I don't know if that was what they were doing right here to create a floor or whatnot, or if they're the ones who've been buying back here. I'm not sure, but I don't even know if they've bought back yet. But that is part of their plan, and they definitely have the cash to do it. So very positive news. We will see how it goes. Until then, good morning and good luck, guys. We will chat.